You want to be better at making money? You don't feel like using complex mathematics or even any maths at all? Watch this video and learn about the principles and indicators of technical analysis. There are a lot of patterns and signals that have been developed to support technical analysis trading. Technical analysts have also developed numerous types of trading systems to help them forecast and trade on price movements. Some indicators are focused primarily on identifying the current market trends, including support and resistance areas, while others are focused on determining the strength of a trend and the likelihood of its continuation. Commonly used technical indicators and charting patterns include trend lines, channels, moving averages, and momentum indicators. In general, technical analysts look at the following broad types of indicators. First, price trends. Price trends is self-explanatory. By definition, a price pattern is a recognizable configuration of price movements that is identified using a series of trend lines and/or curves. In easier terms, the trend is an overall direction of the price of an asset. As you can see on the image on the right, there is two yellow lines which represent two price movements trends. It might look useless on a chart as simple as this one, but it can help you on a chart with a lot of ups and downs, as it will help you get a simpler and quicker view of the general trend of the price and time. Second, chart patterns. Chart patterns are patterns people are looking for when looking at price charts. We will talk about charts patterns in a future video since there is a lot of them and there is a lot to be said about this. For the moment, it's just important to know what it is. Here is an example of a chart patterns. You can see in the red circle that we put two lines corresponding to the movement of the price. As you can see, the two lines get closer to each other. This is what we call a pennant, which may indicate a price breakout soon. Traders will often try to identify patterns to identify trends and try to follow the same direction. But as we will see, it's not that simple. Third, volume and momentum indicators. Volume indicators are hints that might help you predict volume movements in the future, which is self-explanatory too. Momentum indicators are tools used to determine the strength or weakness of a stock price. It measures the rate of the ups and downs of the price. For example, the RSI, which is the Relative Strength Index, is an indicator that measures the momentum of a stock. The image on the right is an example of an RSI chart. You can see at the bottom of the image that when the blue line gets too high, it gets into overbought territory. The bottom line is for oversold. This type of graphic can help you visualize better if the stock gets overbought or oversold. We also have oscillators. There are chart indicators that can assist a trader in determining overbought or oversold stocks in non-trending markets. In order to create a trend indicators that fluctuate within these bounds, an oscillator creates high and low bands between two extreme values. They are momentum indicators and often used with moving averages indicators to signal breakouts or reversals. The image on the right shows an example of a price oscillators on a future chart. Like I said earlier, we won't go into too much detail about the different examples to keep this video short, so I won't explain the graphic. The important thing is understanding that oscillators helps determining overbought or oversold stocks in non-trending markets. Fifth, we have moving averages. Moving averages is often used by professional and retail traders. The reason for calculating the moving average of a stock is to help smooth out the price data over a specified period of time by creating a constantly updated average price. A lot of retail traders will use this because it's an easy tool to use. The image on the right shows a simple moving average. As you can see, it helps getting a clearer image of the market and how it moves over time. And the last one, support and resistance level. You can think about the support level as the floor and the resistance level as the ceiling. If the support level is the price that a stock does not go below, the resistance level is the price point at which a stock has trouble growing past. People use these indicators to see if a stock has problem growing past a certain price point or if the floor at a certain price seems to be solid. If the price keeps coming back to a certain price but never below it, you can deduct that the support at this price point is strong. Let's take an example. A stock at 15 keep going down to 14 and going up. People might see this and think that 14 is the support level, which could be explained by a lot of people having buy orders at this price point. The contrary could also be true. If the 15 bucks keep going at 16 and going down after, a lot of people might have selling orders at $16 that get executed every time the stock gets to 16. In the example on the right, you can see both levels and how to spot them on a graphic. As you can see, it's not the same type of analysis as we talked about in value investing. Here, we focus on the volume and price at different points in time. Like I said earlier, some retail traders use technical analysis because it looks easier to do. You also don't really need a deep understanding of the market if you just look at charts and compare them with your index of candlestick patterns. As always, comment, like, and subscribe if you've liked the video and you want to be a better investor in the future. Have a great one, everybody.